Well, let's start off by saying Happy New Year to everybody. January 1st. This screen that you're looking at is as of December 30th. It is the last screen of 2022. So next week when I do a market outlook, it is going to be the first screen of 2023. So all the rates will change to the beginning of the year rates. And this is the last time we'll see the cumulative effect over 2022. We start the clock over starting next week. But this is, even though it's January 1st, this is for December 30th. The other thing you'll notice in the videos in the market outlooks going forward is you'll see every now and then this term right here in brackets, AS, that's applied series. It means that there is extra content for the market outlook within for those subscribers who have the applied series. There will be content that goes a little bit further on certain things to explain them in a little bit more detail. And I'm going to try to shorten the market outlooks each week to hopefully under an hour so that they're more digestible. Let's begin with our rates. Have a look at the 30-day here, 4.12. It has really come along from 3.8 the week before, 32 basis points up. That really came in the last 2 days of the week, the 29th and the 30th. That really accelerated upwards. Money market rates are all up. Some of them, if you look at the 2-month, the 3-month, the 6-month are hitting the highs for the year. On December 30th, the closing yields are the highest of the year. Capital market rates have all increased as well, so this bear steepener is still going on. So our steepener trade, if you were doing that, the TUT gained another 3 basis points over the week. 179 days inverted on the 2s to the 10s now, and the 3-month to the 10-year is now inverted by 67 days. Let's have a look at what we have coming up. FOMC February 1st, 31 days. CPI for December will be reported in 11 days, and for the those who have the applied series, I'm going to discuss some interesting research I found on demand versus supply issues when it comes to CPI that really fits the data. The examples they give really fit the data that we have now. Jobs in 5 days. Jobs report for December in 5 days. The initial jobless claims throughout December were all in around the 220, 225 range. So I do expect that there will be a positive print, and the expectation is for a print of 200. I don't see that it would be any different. The hours worked, the average hourly pay, and the participation rate are slightly more important now than the headline number. And FOMC minutes in 3 days. So for the week coming up, we've got a few things here. Wednesday, FOMC minutes. Friday, you have the jobs report. That will set the tone. The week after, you're going to hit CPI. And then trailing into that week, you might get the beginning of Q4 earnings. A few of the banks might be reporting. The week after, the next 2 weeks, I should say, is thick into earnings with about 160, 170 companies reporting each week. And by the time you get to the end of the second week of that, we get FOMC. So January is full of risk events. I have been asked to give a forecast for 2023, what I think is going to happen over the year. I simply can't do something like that. I have no idea where we'll be at the end of the month, let alone the end of the year. So it's with all of these big risk events, and until we get some clarity on direction, these are all big risk events. I don't know where we're headed. The FOMC minutes in 3 days could be bullish because we did step down in December to 50 basis points. So the wording may be bullish. The jobs report, if we see the participation rate increase, if we see wage pressure alleviate, that the increase in wages is something under 5% perhaps, that could be very bullish going into CPI. Or it could go the other way, right? It is brutally difficult to forecast random numbers, and when you think about the jobs report, it is a random number, and there's some distribution on which that number could land in. So from month to month, because of the fluctuations and because it gets so much attention, you get a random number that falls either on the bullish side or the bearish side. Could be the difference of a 100-point rally or a 100-point sell-off. So it's difficult to play those particular events because right now there's no clear trend downwards in jobs. And the data that we've been getting lately is, not friendly for what the Fed is hoping to see. Fed balance sheet down another $12.4 billion. All mortgage-backed securities. MBS down $12.4 billion. Commercial MBS down a measly $12.8 million, but still there. For the year, the balance sheet is down $404 billion from its peak. So even though we're still sitting at $8,042 billion from its peak, it is down $404 billion. When I say the balance sheet, I'm really talking about the SOMA, the balance sheet, particularly for the Fed always has securities on its balance sheet, but this is a facility specifically for quantitative easing, and this is what is being run off. It is down $404 billion from its peak. The effective federal funds rate sitting at 4.33, so moving up to 4.12 is in the right direction. Reverse repos. Look at the jump in reverse repos, $337 billion jump in the reverse repo. Now, end of month typically sees an increase. The last day of every month typically sees an increase in the reverse repo. This could be because you have three things going on at the same time here. Not only is it just an end of a month and an end of a quarter, but it's the end of a year. So there may be more positioning and using the reverse repo. It could also have something to do with that we're sitting on a 3-day weekend. So you're not going to let money sit without earning something for 3 days, right? And that earned 4.3, which is 1 day SOFR. The probabilities for FOMC for February 1st really haven't changed that much. Last week for 50 it was around 66%. It's now 67.7, an increase of 1.8 percentage points and a little bit less weight on the 75, but that's really not enough to say that sentiment has really changed. For June, this is the June meeting and the distribution of rates for the June meeting. This is rather interesting down here. A lot of the weight has drifted towards the higher rates. So probabilities here have increased. If we look at the 4.75, we were at 15.6, dropped to 7.7. The 5% was 46.5, is now dropped to 39.5. The 5.25 went from 31.6% probability to almost 40%. And the 5.5, now double digits, 12.3 from 6.2. And even the 5.75 is starting to get some weight, albeit under 1%, but going from 0.1 to 0.7, an increase of a magnitude of 7 times, even though it's fairly small. But the weighting is definitely shifting towards higher rates. And when we look at the Fed funds futures, we'll see that it's reflecting the same thing. Okay, real rates have all increased. Nominal rates have increased by more, so all the inflation expectations, all the break-even rates have increased as well. If we look at the Fed funds futures curve, last week we had the index bottoming out at May and June at 95.095, implying a peak rate of 4.915 or a peak range 4.75 to 5. This week, it's down around 95.03, so we had a drop in the value of the index, which is an increase in the height of the rate, 4.97, which is still inside the range of 4.75 to 5, but is sort of inching up to get to the 5 to the 5.25 range. Is heading up to there. You could say that this is more of a 4.75 to 5.25 range as opposed to 4.75 to 5. Sitting at 4.97, it's an increase of 5.5 basis points. End of year, the index is sitting at, this is December now, sitting at 95.355, which implies a Fed funds rate of 4.645. Last week is 4.515. You can see we're up 13 basis points going into the end of the year. I am now long the September and the December Fed funds futures. I'm also long ZB for June. And I'm using this as a hedge for beta. For most of the year, I wasn't touching duration at all. I was managing my dollar delta beta by selling calls on the SPY. Because the correlation between duration and beta was positive. And when you have a positive correlation, duration is not going to act as a hedge for beta. In other words, bonds are not a hedge for equities. Bonds are a hedge for bad economic outcomes, not for inflation. But I do expect that over 2023, it will become clear that we're heading towards a bad economic outcome, being a contraction. Any contraction is bad. So if we're heading for a bad economic outcome, that negative correlation between duration and beta will come back into play, which means I don't have to sell calls on SPY to lower my dollar delta beta. I can leave dollar delta beta the same and simply add duration. And duration will act as a hedge against my beta. However, when I take on long positions, given that our SOFR rate, the one-day SOFR sitting at 4.3, 3-month is a little bit higher, given that the risk-free rate that prices derivatives is so high, when you're long futures, you have negative carry. So because I'm getting negative carry over here, I got to try to pick up positive carry somewhere else. So if you have the applied series, I show you how I use ES to pick up positive carry to offset the negative carry, and I explain what that means based on the shape of the futures curve. And both the futures curve, well, for any financial asset, the futures curve is upward sloping. It's in contango, which means any long position is going to have negative carry. The higher the interest rate, the bigger the carry, the more negative that carry is. So you have to, when you're dealing with futures, you have to be aware of the carry. And your forecast for where you think the underlying is going has to overcome the carry. U.S. Treasury, if we look at the one year forward and we subtract out the 1 year, we have negative 64 basis points. So this seems to be consistent with what we're seeing in the futures over here. This is the forward, the 1 year forward is what the market is pricing in the 1 year yield to be in 1 year, at 4.09. We have an effective Fed funds rate, or an implied effective Fed funds rate of 4.645 by the end of the year, which is roughly about 1 basis point cut from the peak of 4.97. So the market seems to be pricing in some cut by the end of 2023, 125 basis point cut, with another approximately 2 25 basis point cuts over the course of 2024. That's all it's pricing in at this point. So I think we'll keep watching the difference between the 1 year forward and the 1 year to see if this gets deeper. As if earnings for Q4 will be reported in January, I imagine they'll come in as expected, may even beat expectations because they've all been lowered. It's the guidance for 2023 that's going to be important. And I think that as 2023 starts to unfold, if inflation and jobs are still the problem, the Fed is going to signal higher for longer. Higher rates are going to break something. And if they're going to break something, I would expect that this would probably invert even deeper than 64 basis points. So we'll keep our eye on there to see what the market thinks about the reaction. This, by the way, really just reflects the expected path of the policy rate that's priced into the front end of the curve, because there isn't enough time in 1 year to start pricing in growth expectations into that part of the curve. That really is just going to reflect the path of monetary policy. If we're more interested in what the market is thinking about in terms of future growth and inflation, we would look at the 5 year forward minus the 1 year rate. TLT, let's have a look at that. Didn't have a very good week, down 2.55%. This is not wow, as in I'm surprised. That's week over week. S&P was basically flat, down 0.13%. You did have, and this is TLT, when I say it's down 2.55%, that's price you did have an ex-dividend date here on the 28th. There was a end-of-year dividend here that's payable, I think, on the 3rd. So part of that price decrease was for the dividend. Implied volatility is higher. The 52, the 26, and the 13 are all higher. The 13-week is now at 41% versus 28%. For January of 2024 TLT, the options will be centered around the forward price, which is 104.27. So right around 105. You should find that the call and the put have the pretty much close to the same delta of about 0.5. If you're looking at 99.65 way out in January of 24 and wondering, well, how come the delta on the call is so much higher than the put, is because at that point in time, because of the formula for Black-Scholes-Merton, it is priced around the forward price, not the current price. I am still long January 24. The 110 and the 115 calls. I am short January 23 102.50 puts at 235, being that TLT's at 99.65. Its intrinsic value right now is 315, so I am underwater on those. But I have a choice. I can have them put to me, which is fine. I can then treat that as a separate position altogether and sell calls on that while still maintaining my long calls here, or I can roll my Januaries into February. Typically, you pick up about for TLT, you can pick up about $1 on the roll. So how that works is I would take the 102.50s for January on the very last day of trading. On the day that they expire, I would then roll them to February at the same 102.50s, and I should be able to pick up about $1, which means that this cancels out and my average cost would be $335. And if I have to roll them over to March, you can pick up $1 as well, as long as the price is in and around where you're hoping to roll. If this price drops to 85, well, no, I'm not going to pick up $1 on the roll. At that point, I would just have them assigned to me because the yield would be better than the pickup on the roll that I could get. But as of closing on Friday, the pickup was about a little over $1 if I roll the Januaries into February. But I'm not gonna, I don't think that 102.50 is too unrealistic for the 30-year to go at this point. From the 20 to 30-year, because that's what TLT is 20-year plus. But I do have options. I don't get shaken out of my positions just because they go negative. Now, when I say it has intrinsic value of 315, the market value of these puts is much higher. So it shows my losses being greater than just the 80-cent difference between this. It's like over $1 difference. So on my P&L, it shows unrealized loss is greater than that amount. But I always look at just the intrinsic value because the time value will wear itself out. I'm short the time value, so that's on my side. So as time ticks away, I'm going to make that. So I haven't lost that. It's at 315. My break even is $100.65, which on the chart is sitting right about here. Is my break even on these puts? It'll either be over 102.50. Or I'll probably roll, but I don't know that I would at this price. If we're between 100 and 102.50, I don't know that I would accept delivery on that when I can roll them and pick up $1. I'd probably end up doing that. Okay, and for all the movement in both beta and duration markets last week, equity and bond markets, yields just don't seem to be responding too much. If we look at investment grade. There's our investment grade right there. They've tightened a little bit. Getting some movement in high yield. You're adding 20 basis points here, but you're still under 500. Usually this goes to about 800 in recessions. If you have the applied series, I'm also going to, for this week, discuss the Merton model. And the Merton model gives a good sort of description of what's going on now based on balance sheets. So I'll describe the Merton model and I'll describe 3 particular outcomes. And if it is the case that we are well informed by the Merton model, it does have something to say about the potential downside on equities, that it may not be as typical as any other recession if in fact we find what the Merton model says to be useful. So we'll see what that has to say. Look at the mortgage rate. It did increase 15 basis points. The 10-year increased 13 basis points, and this is to the 29th, so we don't have the 30th, but Mortgage News Daily reports it daily because it uses actual observed rates as opposed to survey rates. 4 basis point increase. So if I add the 4 to the 13, that's a 17 basis point, add the 4 to the 19, to the 15, that's about a 19 basis point move based on the 10 moving 13. You would think, well, spreads have increased. But what's interesting is I look at the mortgage-backed security, the 5% 30-year, dropped by 0.425%. These are quoted in terms of price, not yield. They're quoted in terms of price because you don't know the yield, because there's prepayments. Prepayments could be less than expected or more than expected, so you really don't know the yield to maturity on that. So they're quoted in price. Drop 0.425, but you can usually back out the change in yield, the average life of the 30-year, because of prepayments. Average life is about 12 years, and if you divide that by 1 plus a yield, the yield that you could get on, if you just take a 10-year and you add a typical spread on, you get to about 11.4, which means if you have a duration of 11.4 or sensitivity, these are all just estimates, right? You have a duration of about 11.4. To get this type of drop in price, the change in yield must have been about 4 basis points. So the difference, if you look at what's going on with the 10-year, you look at what's going on with the 30-year, to only have a change in 4, that's a fairly nice mortgage market to be in. We know mortgage market has dried up basically for both refinance and for purchase index. The refinance index and purchase index are at multi-year lows. So if you are a mortgage REIT, or you are a business in which part of, or even an institutional portfolio in which you're holding any mortgage-backed securities or mortgage REITs, there just isn't the issuance. And the average credit score of the mortgage holders is significantly higher than it was in 2007, 2008, combined with a much higher equity cushion that exists now. So that even though there are some distressed mortgages, because there always are, even in great times, somebody can't pay their mortgage, it is lower now than it was pre-pandemic, and way, way, way below 2007, 2008. So the mortgage-backed security market, being that you have lower issuance, is seen as, well, it's fairly safe. Now, it's if you are expecting a slowdown in the pace of rates, you don't need convexity in your portfolio. If you think that the Fed's going to raise another 50 or 75 basis points and be on hold for a while, the convexity is useless. So you may as well sell that convexity. Buying a mortgage-backed security gives you that negative convexity, so there could be heightened demand for it, which is why the spread isn't that high. And if we look at the performance of mortgage REITs on Friday, not so bad. Not so bad at all. Home price index, the FHFA home price index for October came out 0, month over month, 0, year over year 9.8, but that's backwards looking, right? 0 month over month. That if we were going to say, well, what is near-term inflationary pressure? That's 0. Case-Shiller for October. I shouldn't say month over month. Sorry, what am I doing here? I can't say month over month. These are quarterly. Let me just fix that right now. Quarter over quarter. And same with Case-Shiller, quarter over quarter. For October, negative 0.8 year over year, 8.6%. If we break it down into 20 city versus national, the 20 city is a drop of 3.78% quarter over quarter. Nationally, it's 3.04 quarter over quarter. So you're seeing bigger price drops within the cities themselves. Now, that is important because there are about 50 cities in the U.S. Where the majority of the homes are sold. A majority of new home construction, majority of homes are sold in those big, big cities. So we're seeing that where the majority of homes are being transacted, you have the bigger drop. I have some 2023 benchmarks down here. And you probably, as a retail investor, don't have a benchmark because, well, why would you? Why would you limit yourself to overweighting and underweighting components of a particular index and tracking your performance relative to an index? I mean, you might, but why would you? You have so much freedom to do what you want. But that doesn't mean that you should consider yourself benchmark agnostic, because you could get some types of returns passively, which means if you're going to be managing your own retail portfolio, you should at least beat what you could have gotten by buying something and just going about your life, right? Typically, you would use a 1-year rate plus 500 basis points. Why 500? Because that is a high yield spread. And if we look at the capital structure, debt comes before equity. So you would try to get at least a high yield spread because you're going to be all over the place. You're not just going to restrict yourself to just investment grade stock. You'll be buying all kinds of stocks: small cap, mid cap, large cap, tech, unprofitable tech. So if you use a 500 basis point spread on top of the 1 year, your benchmark for 2023 is 9.73. A double B, which is the top part of high yield, because you can find a double B ETF. You can find a high yield ETF as well, but even if you just go in and buy bonds, look at that yield, 7.14%. You could just simply park your money there and be done with it. Even if you decide to go to investment grade, you're getting 5.46. And if you shorten it, because, well, you only want a 2023 benchmark, there is an ETF for IG for only 1 to 3 year bonds. It's yielding 5.3. So you can stick all of your money into that and you can get 5.3%. So if you're going to take on risk, equity has higher risk than debt, period. If you're going to take on risk, you got to at least beat that. So over the course of 2023, write down some benchmarks, write down some numbers, and over the course of 2023, look at your portfolio performance. If you can't beat those benchmarks, you would have been better off just buying those. And how we determine whether or not we're actually getting anywhere with what we do is we have to compare it to something. We have to compare it to some type of benchmark. All right, let's look at the VIX. This is a 3-year look at the VIX. We'll have a look at this before we head to the S&P. VIX is sitting below both the 50-day and the 200-day moving average. If we look at the term structure of the futures, upward sloping. It's not always upward sloping, but it's primarily upward sloping. So I don't know that we want to read too much into that in the sense that we expect that there's going to be greater volatility. Usually if volatility spikes, the front of the curve increases, that's where you get a curve in backwardation. So to see it upward sloping isn't I don't know that's telling us a lot of information here. SPX, here's the implied volatility. The 13-week is at 17%. And that's the near term. That's the more important one to look at, as opposed to looking backwards a whole year. 17%. Where it is now, based on the last 13 weeks, not a lot of excitement in the premiums when implied volatility is that low. In fact, the cost, the return of a straddle, an at-the-money straddle, is something like 4% on SPY. You can get 8, 9, 10% on other securities. That 4% just doesn't seem very interesting. Not that I would sell a straddle, but it's a good way to measure the amount of premium at the money, is to take the straddle, the combined call and put together, and divide them by the at the money price to see what that yield is. The higher the yield, the higher the volatility, but the higher the possible return. VIX is a mean reverting series. 19.6 is sort of near-term support over here. If we think support in the sense that volatility will drop, we could probably call that resistance, because there's an inverse relationship between the VIX and the SPX. 19.6 Not a lot of movements in the VIX, still sitting fairly low, even with some of the moves we had last week and some of the selling we had, some of the buying we had. The VIX really didn't really move that much. The mean reverting level is lower than 21.72. I tried to find a mean reverting level for the VIX to see if anyone had done any research on this, because I didn't feel like doing it myself, for like 3-year, 5-year, 10-year periods. Because one thing about the VIX that's important to know is that it is short-term mean reverting with a medium-term persistence. So if we think that this is a mean reverting level and we're watching the VIX and we see a spike up, those spikes usually don't last long. They come down, but they have this medium-term persistence where they'll come back to their mean reverting level in the medium term, but in the short term, spikes usually don't last very long. You can see that here, right? They don't really last that long, but then you have this drawn-out effect over here that you have this medium-term persistence. But right now it looks, barring any significant activity or something breaking in the economy, any significant activity in the equity market or anything breaking in the economy, this looks like it wants to drift downwards more. There just doesn't seem to be that much fear. It does make sense. I mean, you've had a whole year of rising interest rates and the market doing this, coming down. That as far as institutions go, if they wanted to reduce their beta exposure and rotate out of high beta stocks into lower beta stocks, rotate out of growth into value, a lot of that portfolio reconstitution or portfolio turnover, let's call it, by the end of the year is probably done. They're probably where they want to be. And maybe not so much in need of portfolio insurance at that point, because they're probably unwilling to pay, given that they've already lowered the allocation that they have anyways, or that they've cycled out of consumer discretionary into consumer staples and healthcare. So it could be that just over the course of the year, as you had each rally and sell off and rotation in the portfolio, because we can see this downward trend over the course of the year, that on each sell-off there was less and less need to continually protect yourself, because you use those rallies to say, well, let's take profit off of these, let's move into these low beta names, let's move into high quality, let's move into high dividend, low vol. They might have already gotten all the factor exposures and sector exposures that they want, which means that if there is a sell-off, there might be more willingness to say, look, you know what, we're already positioned to outperform the index anyways, so we don't really need to really outperform the index to keep our jobs. We just need to outperform the index, and if we're already in factor exposures that are expected to outperform the benchmark, why buy portfolio insurance? It might just be a drag on performance. So it just could be that it's not signaling that, oh no, volatility is going to continue to drop. It just could be signaling that, because it is the fear index, it just could be signaling that even if the index is going to drop, there's not a lot of fear about it. Okay, SPY, the forward 4-quarter EPS estimate, 222.91, has come down again. It's not dropping fast, but it has come down. That's the forward 4 quarters. That is the last quarter of 2022 and the first 3 quarters of 2023. That's not full year 2023. Full year is higher than that, sitting around 229. SPX closing 38.39.50, which gives us 17.22 on SPY. You'll note on this chart, you see this green over here, pretty much right at that line. That is my long position in SPY. I do have a long position. Implied volatility, 13-week, 22%, still quite low, sitting at 20.399. It peaked way back here. You have these big peaks. They match these, whenever you have these big sell-offs, they match, the low points of these sell-offs. That was sitting somewhere around 28.29 on IV. We're at 20.4, and looks like it's, trending downwards again. Probably just lack of fear, as opposed to it meaning that there's a wide belief that we won't have an increase in volatility. Below the 50-day, below the 200-day, 389.03, we ended at this is after hours, 380. 323, but around 383. 18 times is 399.65, basically 400. You have this downtrend at 401. You'd have to pretty much get to the 200-day moving average, and that would be at 18 times earnings based on what these earnings are at this point. 16 times brings you pretty much to the October low, 355.24. At the money straddle, 4%. That's only 20 days, mind you. It's only a 20-day at the money straddle, but you can do better on single names at this point. ES, which is the S&P Mini, is in contango. It's financial futures. They're always in contango, which means upward sloping. So a short position is going to have positive carry, and I will contrast that positive carry with the negative carry on ZB. In the applied series for this week. That video is being done at the same time that this one is. I do all the screens and I just take the couple of the screens out, but it's January 1st. January 2nd is a holiday in Canada, so you probably won't see that show up till January 3rd, but it'll show up in the applied. There's you should have a folder for all the applied series, the market outlook videos. It'll show up in there. I'm looking to sell June futures at 39.50 or higher. Right now we're sitting right at 3,900 on the June futures. I'd like to see some kind of early week rally, and I think the minutes from December are probably going to lean dovish. Which could be bullish for the market. So I have the patience to wait, but because I have duration now, and I think duration will be negatively correlated with beta going forward. Maybe not tomorrow, maybe not next week, but over the course of the year it will. So I can wait to sell the June ES, but I'd like to get 39.50 or higher, depending on the tone on Tuesday. And the volume, because it'll be the first day of the year. We had low volume going into the end of the year, into the end of last week. If we're coming out with decidedly negative sentiment on extremely high volume on the first day, I won't wait. I'll get on board, depending on how it's looking overnight and what the tone is overnight. One thing I don't want to underestimate is China and the COVID cases. They're sort of just saying, okay, fine, you don't want to go into lockdowns, fine, here you go, you're on your own, and you just had New Year's Eve, and there's this new variant that appears to be it's not more contagious, but more immune resistant, but it doesn't seem to make you sicker. It just means that you're more likely to get sick from it, but it won't make you sicker, nor does it transmit faster, but still, it is increasing. And, from what I saw from pictures from New Year's Eve that, were on YouTube and around, people in crowded places with no masks, that's got to account for something. So I would be very careful about ignoring that. I mean, it's in the background. We've had enough of it. I know we've had enough of it, but it's not gone. It's still there, and it could come back. I don't know that you're going to get lockdowns again, but you may get voluntary withdrawals from the economy for more people that decide that they're not going to go to the mall, that they're not going to go to a concert, they're not going to go to a game, they're not going to go to crowded places if it starts to become a thing again, where the hospitals get crowded and you're short on ventilators, and that whole story starts showing up on the news again, you may get voluntary withdrawal from the economy, which could be, that negative shock that's needed in a low growth environment to really contract growth. So I wouldn't, I'm not going to put it front and center, but I'm certainly not willing to say, sure, there's COVID. It's, especially with China, the cases per day is astronomical, and the deaths per day, they're not reporting a lot of deaths per day. They're reporting like 12, but apparently it's like in the tens of thousands per day. So we'll see what happens. We'll see what happens there. But we got for January it's hard to say where we're going. All I can do at this point in time is say, well, look, I'm looking to balance my positions as well as possible. I want some positions that if things go bad, they're going to go up while everything else goes down. If I can't find that, then I'm going to use some derivatives to try to lower the exposure I have to particular sectors or particular factors. Pretty much beta is what you're trying to get rid of. Other than that, as tiring as it's been for the last year, data point to data point, that is where we are again for January. You have Wednesday. We'll look at the calendar. How's that? We'll look at the calendar and we'll see what we have coming up. Okay, so Monday, nothing going on, both Canada and the U.S. On January 3rd, you have some manufacturing PMIs for December for both Canada and the U.S. It's S&P Global, which I think is good, but it just doesn't have the brand name that ISM has. So, it just doesn't seem to get the same kind of respect. Construction spending at 10 on Tuesday as well. Going into Wednesday, everything's going to be looking at this one right here, the minutes, the FOMC minutes. You do get ISM manufacturing, and let's not forget, I don't know why they have this on low, because we know the Fed is looking at it. But we have JOLTS, the job openings, and the job quits. You want to start seeing these quits getting below 4 million. They've been elevated above 4 for so long. Not that under 4 means anything. It's just this psychological number to see a 3 that we haven't seen for a long time. To get out of the 4s to see a 3. It's not like it's 4.06 and then it went to 4.01. It's like 3.99 would be psychologically so different. And we have the job openings. Like to see those come down as well. Then you have your minutes. Canada, the 8:15 on January 5th, ADP employment change, forecast of 145. The always wrong ADP. So, they changed their method to try to be more precise or to align more with, Bureau of Labor statistics. But they're still wrong. I remember years ago, about 15, 20 years, I think it's like at least 15 years ago. I don't know if I ever paid attention to it before that, but it was commonly called the always wrong ADP report. So I don't even know why it even is still here. Balance of trade for Canada, if you're watching the Canadian dollar, anything stronger will be a positive, but it's always short-lived. Balance of trade for the U.S. as well. You have initial jobless claims, continuing jobless claims. They keep ticking up. But still, overall, if you take a longer term look at it, it's still quite low compared to a long-term level. More S&P PMIs. These are composite. This is the composite. Their services early in the week. You had manufacturing. We keep going here. There's the big day on Friday, both for Canada and the U.S. The employment change and the unemployment rate, average hourly earnings. Almost everything is important now. Average weekly hours and the participation rate are important. Following at 10, ISM non-manufacturing PMI, which is services, and one Fed speak for the week coming up. 4 days, but you've got the minutes, which I think might be dovish, following heavily into the jobs report, which, who knows at this point. It's, forecasting this stuff is rough. So it really is in this market so far for January. It's data point to data point. And then once we get out of this week, we think we're okay. You got that big, bad, ugly CPI next, the week after. And if that follows the trend, and you're starting to see earnings trickle in that are beating expectations, even low expectations, you could have a big shift in probabilities to the 25 basis point to a 25 basis point move for February, and a rally for January. So it's tough to play because if the number comes in higher and breaks the downward trend, you could easily just sell off just as fast. Every point seems to be a make or break point. It's so difficult to have a life when this is going on, because I got a life. I want to live it. I got other things I want to do, but you have to say, well, I got to be vigilant on this day. I got to watch on that day. I've never done so much active investing as I have in the last couple of quarters. So anyways, there we are. For the applied series, the extras will be up probably Tuesday morning.